who cares? These people suck. Like, there are some industry reports I put in quotes that is, if you actually dive into it, it's a bunch of garbage. They're coming up with fake numbers and they're putting fake projections, and I've linked to them before on accident, and other people have too. It's kind of a sham. So you really have to be careful on the internet when it comes to industry reports. How you gauge how reliable someone else.
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks. Welcome to Investing for Beginners podcast. Today, we're going to talk about what we can learn from Warren Buffett's 4 pillars of investing. So if you live under a rock, you may not have heard, but Warren Buffett recently announced that he's going to be going, air quote, quiet. He released his last missive to us before he steps down. He wrote a letter for Thanksgiving, and it's available online, and it's a great letter. But we thought we would talk about some things you can learn from Warren Buffett and how these ideas can make you a better investor. So he has 4 pillars of investing that we're going to kind of talk through. So I'll go ahead and list them, and then we'll go ahead and start chatting. So the first one is the quality of information. The second one is consistency of earnings growth. Number 3 is finding opportunities around your investment style. And the 4th is the importance of management and how to find good managers. So let's go ahead and dig into these. So when you think of quality of information, how is that important to us as investors?
I think it's super important, and I think it's becoming more important the more and more technology and access there is. One of the great developments that we've seen in the stock market and in the investment world has been the democratization of finance, and finance has become so much more accessible in the United States, and hopefully over the next couple decades it will also be that way in the rest of the world. But with that has come just a flood of information, some of it good, but some of it bad. And just because information is commonly accepted or a lot of people are repeating certain information doesn't make it quality information. So you can give yourself an edge over the consensus simply by having a higher standard for the quality of information that you are using when you make these decisions. So I would be curious from your perspective, and I kind of want to flip it on you for a second. What would be some bad quality sources of information that investors should avoid or at least take with a huge grain of salt?
I think probably the first thing that I would consider would be any sort of information you get from a friend or a family member or somebody you work with. If they come to you and tell you, hey, I heard about this great company, or I just read about this great stock and they do this, this, and this, and this, that may be okay for like just getting introduction to a particular business, whatever the company may be. But if you're going to go invest on that and that alone, you're setting yourself up for a really hard potential fall. So that would be probably the first thing I would look at. The second thing to consider would be a lot of information that comes to you on social media is not vetted or is repeated from somebody who started the chain, becomes viral idea. And if you don't verify it, then it can be a problem. And I'll give you an example. This happened to me on Twitter a while back. I was looking for some content to post, and I found an image that looked like some information from Ben Graham that was written by Ben Graham. And I was like, oh, all right. And the person that I copied it from, I was going to give them credit for it. And I did give them credit for it, but I thought that they had done the research on the information. And so I just dumbly just copied it and put it in there. Lo and behold, Jason Zweig was the one who wrote the copied picture that I wrote. And I was crediting Ben Graham, not Jason Zweig. And he somehow saw it and sent me a message saying, hey, that's a mistake. You need to, check your resources and whatnot. And I took it down immediately and apologized. But that was, to me, was a very important point. Like, just because you see an account that you trust saying something doesn't necessarily mean that the information is right. I'm not saying it's always going to be wrong either, but it will do you 5 minutes of due diligence will put you in good stead. So those are two places I know the media can be sometimes suspect, but those two are probably the two highest ones for me. What about anything stand out for you?
No, I think you covered it. Like, social media can be very insightful at times, very inspiring at times, but also you can potentially have false information. So, like you're saying, and I think some of the hallucinations are happening more and more frequently. So we just have to be careful.
Yes, for sure. So to counteract that, where would you go to try to make sure that you're receiving quality information?
We can go back to Warren Buffett and hear what he had to say about it. He was a big proponent of just the annual reports and the quarterly reports. He did not spend time with anything that Wall Street produced, which I thought was kind of funny. He was very adamant about just the annual reports and the quarterly reports. So that worked for him for the type of businesses he invested in. That might not work as well for something where the numbers are driven because of like technological advancement, for example. But he very intentionally picked a lane where you can look at the big picture, you look at the big picture numbers, and you get a sense of some of the stability and the developments of certain businesses. And so that's, to me, that is the best place. That is, you go to the source and you go to the annual report and you see what is in there. And to me, like, there's no better alternative than that.
That's easily the first place that you should start when you're trying to gather information. And to your point, he spends his day reading annual reports from the company, and he will read not just a company he's interested in, but also he will read all the companies around it to get a sense of the industry and who are competing against those companies. And so he will do a lot of research around that and do a lot of reading. And that's really how he's obviously like the Michael Jordan of investing. Like, he's got this incredible memory, and it retains a lot of the information that he, acquires. And so he, like everything else, it compounds. So the more he learns about Apple, the more he's going to learn about competitors to Apple. And that just helps him make more informed decisions. And that's part of why he's been so successful.
Yeah. Going to the source has so many benefits, but one great example would be if you are familiar with the financials of a company. So if a company is in 3 segments and maybe one company is only 2% of their business, then you can basically filter out all of the noise around that 2% of the business and understand, okay, this doesn't really affect my investment in this company. Sure, it generates headlines. Sure, Waymo is an exciting service, right? But what are the revenues and what is it producing? And is that going to actually make an impact over the investment time horizon I have for a stock? I don't want to like beat up on straw men, but it does feel like people get tangled up in arguments over companies on stuff that really doesn't matter if you just would have looked at the annual report and realized that there's actually this driving the business and everything else is noise.
How do you feel about any sort of like tangential sources of information, like industry reports, or maybe listening or reading things that experts will have? So people that maybe you have vetted and you feel like these people know their stuff in a particular industry because that's what they focus on. Like, how do you think about that?
Yeah, it's definitely a sliding scale. Who cares? These people suck. Like, there are some industry reports I put in quotes that is, if you actually dive into it, it's a bunch of garbage. They're coming up with fake numbers and they're putting fake projections. And I've linked to them before on accident, and other people have too. It's kind of a sham. So you really have to be careful on the internet when it comes to industry reports. How you gauge how reliable someone else's research is, I think you really have to evaluate the person. And to your point, like you're saying, Dave, if somebody has proven that they have the knowledge, they have the incentives are aligned, they are doing things and uncovering research because they want you to benefit the reader as well as it benefits them as well. I think that is a huge factor. And then, yeah, just showing that expertise through their work is a great way to be able to evaluate something. And to go rip on social media again, I think a decent filter, and this is just my opinion, this isn't the opinion of Investing for Beginners podcast, but like an anonymous face on Twitter, I am way more skeptical of than somebody who's willing to put their face and their name out there and actually take ownership of their ideas.
Wholeheartedly agree, especially not only if it's an anonymous name, but there is no picture at all. Like they haven't even bothered to put a fake of anything. At least, if somebody puts I don't know, a picture of Warren Buffett on there, then it's like, okay, at least they tried. But, the people that are espousing opinions that are anonymous names and also anonymous pictures, like they literally, you just see the little blue, shape of a person's head and that's it. And like, okay, that's a hard no. Like anything else, you have to do some vetting. You have to do a little bit of digging to find there are good people out there. You got to make sure you try to find the ones that are responsible and reputable, and you will, and they can be very helpful.
Mm-hmm.
So let's move on to the next pillar, which is consistency of earnings growth. So what does that mean to you?
Yeah, this is important because we can get so wrapped up in the numbers, and I'm guilty a lot. But a lot of the numbers that investors use is very related to what has a company done for me lately. So what are the earnings lately? And that sounds like a great idea, but it can get you into trouble if you are looking at companies where the earnings is not consistent. I'm not going to do it justice, but if you are serious about stock picking and things like that, I think it's worth you doing the time investment. But if you learn about the difference between compounded returns that are smooth versus those that are up and down, you'll have basically the way the math works out is if a company's earnings really tank and they tank often, and then when they rebound, the rebound sounds great. Oh, we rebounded earnings 300% or something. But depending on how much the earnings tanked, you're actually over the long term, they keep doing that. You're not actually getting good compounding because the losses of earnings really take away from the compounding. And it works the same with stocks, by the way, which is why what Buffett has done is so brilliant, and you only really see it play out over the decades that he invests. But that is just the math of compounding, where these swings and these big drops in growth, they take a big backseat, and they do not beat just slow, steady, consistent, because the consistency compounds. And so lots of reasons why earnings growth is important, but those are just kind of the first two that come to mind.
Those are great examples. Our friend John Rotanti has talked about this, the durability of the earnings. He mentioned that was one of the strengths of companies that he looks for, was this durability of earnings. And it goes back to what Buffett has taught us about the consistency of earnings growth, because a lot of that tends to relate back to this idea of moats or competitive advantages. And companies that have a competitive advantage for a long period of time will be able to grow earnings for a long period of time. And one of the things that Buffett has really loved about the companies that he's invested in is that he none of us can predict what's going to happen tomorrow, let alone 5 or 10 years from now. But one of the things you can do if you have companies that have competitive advantages that are strong enough that they can compete and be a consistent grower over a long period of time, then you can have some success of predicting how well a company could do in the future. It's one of the benefits of a company like a Visa or MasterCard. Their earnings are like clockwork, and it's easy to project how well it'll do 5 or 10 years from now. Now, will that be right? That the time will tell, of course, but based on what they've done in the past, it's easy to look at. Costco, it's another one. Companies that Buffett has had huge stakes in, Coca-Cola and American Express, have both had very consistent, strong earnings over a long period of time. They're durable. And so he loves those kinds of companies, and we all should. It's really hard. It's really stressful to invest in companies that do not, that you're always worrying about what's going to happen the next quarter. Is this going to be the quarter that it finally ends? I was talking to Nick from Chip Stock Investor yesterday a little bit about NVIDIA. And that was one of the things I mentioned to him is like, that's one of my concerns about the company is when is it going to end? I'm not saying it's going to. I'm not trying to bash on NVIDIA, so don't come at me. But it is a narrative in the market right now about what's going to happen. When is this train ride going to end? And so that's why Buffett talks about these consistency of durability of earnings, and it all revolves around a moat and the strength of the business model that these companies exhibit. And the more you understand the business model and the better you understand the competitive advantage this company has, the easier, air quote, easier it will be to try to predict how you think the company will do going forward.
Yeah, you're absolutely right. You're going to be right more times than not if you can do that. And that's the best we can hope for. So what are some of the ways that we can look at historical data and try to find those companies with sustainable earnings growth?
Well, I think the easiest way to do it, if you will, is to try to look at a longer time horizon. So whether it's just looking at a quarter or two is not going to get you to the promised land. You got to look at 5, 10, 15, 20 years if it's available to be able to see how this company is done over a long period of time, and not just looking at one aspect of the growth. Obviously, revenue growth is important, but you also want to look at the growth of the margins of the business and how well those are expanding. Those can be fantastic indications that the company has pricing power, it has operating leverage, it has something that people want, it's popular. And if they can do that continuously over a long period of time, it means management has figured out a way to sell a product that people want. They can do it profitably, and they can keep their finger on the pulse of the business and keep it going over a longer period of time. So what did I miss?
I mean, that pretty much hits the nail on the head. We could go a million different directions with it, to be honest. So
Okay.
I like that. Is there anything else you think? I mean, maybe just touch on the moats briefly, and then we can move on to the next pillar.
Yeah, I would, when you're looking at a company, try to determine what gives it a business strength. And there's 5 or 6 of them that you can look at, but I'll just touch on 2 or 3 of them that are probably the most common. Network effects, switching costs, and scale benefits. So network effects, basically, if you understand a company like a Visa or MasterCard or even Meta, the stronger the network is, the stronger the business is. The more people that are on the network, the stronger the network becomes, and becomes this self-fulfilling flywheel that helps make the business stronger. If you look at switching costs, the more entrenched a business becomes in their customers' lives or processes or businesses, the harder it is to switch. You think about banks. Banks, to me, is always the perfect example. I've said this before, people have longer relationships in a lot of cases with their bank than they do with their significant other. And that's a lot in part because it's such a pain in the butt to move your accounts from JP Morgan to Citibank, for example. So switching costs are a very strong moat. And then scale benefits. The larger a business is, the more discounts or more impacts, benefits they can pass on to customers, and the easier they can make it for customers to save money. Walmart is a perfect example of this. Amazon has also, excelled at this as well. And so those are three of the main ones, but there's lots, there's 6 or 7 main ones, but there's lots of different nuances to all of these.
Yeah, totally. And those are some great examples of companies that really exemplify that.
Yeah, the next one is finding opportunities around your investment style. So Buffett kind of, I guess the way I interpreted it, he had 3 main ways that he kind of invested in. Those were generals, workouts, and control situations. And I think instead of maybe focusing on those, I think I would probably rather discuss what your investment style is, how you figure out what that is to work for, and then how you find things that fit within your circle of competence.
Yeah, I mean, he famously changed from a deep value kind of investor to more of a long-term quality investor once he met Charlie Munger. And so you do wonder, like, how much of that was driven by kind of seeing the limits to size, what happens with scale. Yeah, I mean, I think for me personally, I know that I've been a poker player for a long time. Didn't quite play when I was coming out of the womb, but I know my grandfather started me really young. And so I've always been big on math. My mom actually did get me, I think, in the womb with the math part. But always been big on math, always been big on numbers and probabilities. And I just love, playing the right cards at the right time and making the right bets at the right time. That's a big poker thing. And so that's always appealed to me personally as an investor. And so I've had to decide, and it didn't happen on day one. I obviously gravitated towards strategies that prioritize numbers, but I had to decide as I matured as an investor to focus on companies where that would be an advantage to me rather than a hindrance. The numbers don't mean much when you are going IPO and you have a company with big dreams, big ambitions, big story. They're just a baby. You wouldn't measure a person's ability to jump when they're 3 months old to figure out if they're going to be in the NBA or not. You'd probably have other factors than just their sole numbers at that time. So IPOs, growth stocks are in that similar camp. And for me, I realized that the numbers approach can work, but I also had to stay very diversified. It is not something that generally would be a great idea to put half of my portfolio in something just because I really like the numbers, because that's making too big of a bet. That's going all in poker on something where your odds aren't as good as maybe you think. And that's one of the challenges with the stock market. It's not just a deck of cards. There are many factors where sometimes the numbers work out, and other times in other businesses and other industries and other innovations, the numbers really get mixed up. And so you have to have a lot of experience and humility. And I believe strongly that the market goes through these cycles. That sounds obvious, right? Obviously, there's bear markets and there's bull markets. But I also believe there's cycles in what things are popular with investors. So sometimes the numbers are the hot thing and sometimes the stories are the hot thing. And you can really apply that to so many nuances around investment styles. And so to your point, like, you do have to find what works for you, because if you keep chasing whatever is the hot investment style of the day, you're going to be constantly chasing after your own tail and never actually bearing the fruits of your own personal strategy. So huge, long soapbox for that, but that's kind of some of the takeaways I've had and some of the realizations I've had as I've been a stock picker over the years. I'm curious about your investment style, and has that changed over time as well?
Oh, it most certainly has. I do want to say one thing. I am super jealous that you know how to play poker and have been good at it and understand the whole odds behind everything. I will freely admit that I am the world's worst poker player. And if people want to make easy money off, I am that, what is that saying? If you ever wonder who's the sucker at the table, you're the sucker. I'm the sucker. So I am not good at poker at all. So
don't tell those NBA players.
Yeah, right. Ouch. So yeah, my investing style has definitely evolved since we started all this, and as I've learned more, a lot of it has to do with when I first started. For me, numbers were very important, and they still are, but they also gave me they provided me with a security blanket. Like I could look at the numbers, I could try to understand them, and it would make me feel like I was, air quote, more in control of the decisions I was trying to make based on just looking at what a number would tell me, whether it's, the gross margins are growing or the return on invested capital is improving. Those would be indicators to me that this was a good business. And so I didn't do the second part of it as well, which is trying to figure out the, I guess, narrative part of it, and what are the numbers telling me? What kind of story are they telling me? And I'm not talking about, the social media, this is going to the moon because of whatever. I'm more talking about, what kind of competitive advantage does this business have? Where do they sit in the industry that they're operating in? Are they a leader? Are they second? Are they third? Are they an innovator dilemma in this industry? Any of those kinds of things I didn't spend a lot of time on. And that is now something that I try to spend more time on than I did in the past. And so even though numbers are still important to me, I try to balance it with as much qualitative as I do quantitative. And I think I probably become more Charlie Munger than Warren Buffett in a way. And I read a book by Professor Oswald de Motorin called Narrative and Numbers a few years ago, and that had a big impact on me. And I think as I've evolved, I've tried to marry those as much as I can with the knowledge that I have, and then I also try to stay within my circle as much as I can. I do try to push it, but I also try to understand that, biomed kind of companies, which could be great investments, are not my thing. And so I don't try to play in that sandbox. I just try to stay in places that I think I can be successful in.
Yeah. And it really speaks to the whole consistency of earnings that we were talking about a little bit. It goes hand in hand.
Yeah, absolutely. Yeah, it's all intertwined.
Do you remember what got you into really looking deeply at moats?
Yeah, I think actually it was probably the failure of Intel. Mm-hmm. And because that was a very much a numbers based decision, mm-hmm. and investing in that company was solely, I remember one of the things that I kept saying over and over again was they're spending more in R&D than AMD makes in revenue, and how could they not be successful doing that? And that was completely the wrong thing to look at. And so getting burned by that made me realize I need to dig deeper than just the numbers. I need to understand the business model. I need to understand what's going on in the industry and where the company is in the industry and how others are competing against them. Because if you don't have that, then you're going to make, dumb decisions like I was doing. And so that's what that to me was a big turning point.
Yeah. I mean, in your defense, a lot of us also felt similarly. It was a great value stock at the time.
Yes, it was. It was. But to your point, nothing's for free in the stock market, and sometimes a good thing is too good.
Right. Yeah.
Right.
Very true.
Our last pillar is the importance of great management and how to find it. So, mm-hmm. how do you kind of approach this?
Yeah, I mean, how do you pick your loved one, right? It is definitely a harder thing. I guess with the stock market, we do have the benefit of being able to measure performance, measure how a business has done. And managers, CEOs are becoming more and more accessible. I'm seeing a lot more CEOs do podcast interviews and things like that, which sounds obvious now, but I'm telling you, like when we first started, that was unheard of. It was unheard of. When Elon Musk first went on Joe Rogan's podcast, that was one of for the many reasons that was a huge event. It was because it's like, wow, like a CEO from a public company that's in the S&P, So yeah, we're very fortunate to be able to do things like that and be able to listen to how they talk and see what their priorities are and figure out if you agree with where they're taking the business, because that can be a very important piece as well.
It really is. And I think because trying to evaluate management can be such a squishy thing, there are some numbers you can look at, but it's really hard to try to evaluate people. And so the challenge, to your point now, it's becoming easier. Perfect example is, Satya Nadella has been the CEO of Microsoft, has been on 2 or 3 podcasts in the last couple weeks. And when I bought, Microsoft back in 2014, that didn't happen.
No.
And, now, it's not unusual for these people to be on podcasts. I think some of them even have their own podcasts. So they're talking regularly to people. And so it's another source of information. And the nice thing about that source is it's not scripted. And sometimes, depending on the interview, sometimes it could be more revealing than it can be looking at the numbers of the business. It may be very evident that they know nothing about the business and they're just a figurehead, or you can really tell that these people really know their stuff and they really are well ingrained in the company and are driving it forward. Buffett really spent a lot of time talking about the importance of management, because I think he understands that when we give our money to these people, these are the people driving the bus. These are the people making the decisions. And it's important to try to understand them as best you can, because nothing will sink a great company or great investment than a bad manager. And so trying to understand that, have your head around that as much as you can. You can look at numbers, you can look at the performance, and those are things that you can use to track that. A harder thing to do is to track what they say versus what they do. That means that you have to take notes and then you have to refer back to your notes. So those are harder things to do. But the squishy part of listening to them talk, trying to interpret their meaning behind words and earnings calls and conference calls and interviews that they do can also be helpful. But it's definitely a challenge to kind of suss out whether a manager is going to be good or not.
Yeah, and definitely a lot of different things we could look at. So what would be, let's bring it full circle to the quality of information. What's a quality of information source that we could use to evaluate management? I know there's one that you'd use very well in your write-ups.
That would be the 10K. That is the place that you go to find all the information you need to know. And they're going to tell you in the MD&A, the management discussion and analysis, what is going on with the company, what their plans are, where they hope to go. All that's going to come from there. And so that should be probably the first source of information to analyze, is what does management say in their financial statements?
Yes, 100%. What's the next?
The next one that I go to is earnings calls. I listen to the earnings calls of the businesses. Frankly, I don't, depending on the company, if Visa or MasterCard, if I'm listening to their calls, I don't really listen to what management has to say as far as like their preamble. I will only listen to the analyst portion of the call. And the reason why I do that is because I know those companies pretty well. And so I can probably get a pretty good synopsis of what they're saying just by looking at the highlights of the notes. And then if there is anything off, hopefully an analyst is going to pick up on it. But the interaction between the analysts, what they say and how they treat people and the words that they use and how they talk to people can tell you a lot about the person in general. And also, again, whether they have a pulse on what's going on with the business. You can pick that up pretty quickly.
Yeah, totally. What would be the next?
Probably the last one would be the aforementioned podcast interviews. So if you are able to find a podcast interview that you listen to, you can pick up a lot from there. Again, it's more related to soft skills and things of that nature. But I guess I would also kind of tie that in with reading anything that management might write. Whether it's going to investor days, not going to investor days, never actually been to one, but listening to their calls that they do with other investment bankers and all their management team can be very illuminating. So those are some other things that I try to do.
Yeah. One of the favorite things that you do that I really appreciate is the incentives, looking at the incentives, looking at compensation, looking at the proxy statements. Charlie Munger, this is something I've heard you say many times on the show. Charlie Munger has a quote, show me the incentives and I will show you the outcome. That can be a really great thing because you might look at a company and be like, oh, wow, they are very super focused on revenue growth, but they do not care one bit about profits. And then you look at how they're compensated and, oh, it's based on revenue growth and not profits. Or it's based on earnings growth and not return on equity. You'll start to see those things, and the clouds will start parting, and you'll be like, "Oh, I'm starting to understand this a little bit." So I like the way you do that. Like how did you get into that, and how have you gotten better at that over time?
Well, number one, doing it. Number two, I read 2 or 3 years ago. Somebody was talking about that very thing, incentives. I was reading a blog post and they were kind of doing an assessment of Berkshire's incentives. And it kind of like just not alarm bells, like ding, 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 like, hey, I probably should do this for other businesses. And then this other person, I was looking through their stuff and they actually did do that for a business. And so they kind of wanted to show the difference between Berkshire, which was probably the gold standard of incentives, and this other company that was not. And I frankly don't remember the name of the company, but one thing I do remember was that they were heavily compensated on adjusted earnings per share. But then, which is okay, fine. But then when you started looking at what the adjustments were, there was like 15 adjustments that they could do. And then the other kind of, I guess, insult to injury was that the growth in adjusted earnings per share was literally like 3%. That was the hurdle they had to beat to, get 200% of a benefit. And, this company was, growing earnings at, generally 8 to 10% a year. So the compensation committee was sandbagging basically shareholders by basically giving these people huge payouts for literally doing nothing. And so that was a red flag for that business. And so those two things made me realize that this is something I need to pay a lot more attention to. And I've seen it in other people's write-ups through the years. And so it's part of my process now is to read through the proxy and try to, determine what are the incentives, how are they getting paid, how much are they getting paid, does this match up with others in their industry? CEO pay is a fairly controversial topic, but it is also important to understand how they do earn the money that they earn. And sometimes it's actually good for us. Sometimes it's not. Sometimes it's neutral. So it just kind of depends. But I think it's very important. To your point, the incentives do matter.
Yeah, totally. This was a bunch of great information. The 4 pillars are fascinating. And what's great is how timeless this is. This worked for Buffett. It works for us. It can continue to work for us in the future because they're big picture ideas that we can apply to every business. And that really encourages me. Any last words, any final words of advice? If people want to read more about this, Dave did a great blog post, einvestingforbeginners.com. You can just search Buffett's 4 pillars, something. Let's see, what's the actual name of it? What we can learn from Warren Buffett's 4 pillars of investing. Really goes into the deep dive there. But do you have any final thoughts on any of the pillars, all the pillars? What do you got?
I think the last thing I probably would leave everybody with was these are all 4 very interconnected components that are part of doing fundamental analysis of a company. And if you want to invest in the style that Buffett does and Charlie Munger does, that Andrew and I have done, then these are things that you need to try to follow as best you can at the ability that you can, and learn how to read, take notes, and enjoy reading 10Ks, because they will be the gold mine in the canary in the gold mine that'll lead you to the place that you want to go. And they will reveal all, maybe not all, but they will be extremely, extremely helpful.
Perfect. Yep. Totally agree.
All right. Well, with that, I'll get off my soapbox and we'll go ahead and sign us off. I hope you guys enjoyed our conversation on Warren Buffett and his 4 pillars. He still got it, and we can still learn from him even though he's stepping away. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.